Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Wednesday. It's February 8th, and it's 8:07 in the morning. The market's going to gear up to open up in about an hour and 23 minutes, and I still have my math functioning skills available to me on demand. The Nasdaq is down about 38 points. The Dow's down about 135 points. Nothing really all that great. Yesterday, the market rallied because Mr. Jerome, I'm not going to be honest with you till you reappoint me, started talking about deflation, and I'll talk a little bit about that in a minute. I don't believe what he's saying because I believe the target rate is not going to be 4.8 or 4.9. I actually think it's going to go to about 5.2, 5.4. So I think he's got a lot more work to do before his job is done. Now, in terms of the broad market, we've got wholesale inventories coming out today. We've got the petroleum status report, and tomorrow we've got jobless claims. He also made a little note that says if jobs keep coming out as strong as they are, they're going to have to take more action, and I think that is exactly what's going to happen. Now, let's talk a little about earnings. One of the reasons why you've been seeing so much volatility and so much directionless movement up and down, back and forth, is because earnings are here. And today you've got the big mouse reporting. Let's just take a quick look here. Curious to see how Disney's looking today. The big mouse. It's opening. It looks like it's opening up a little higher. I don't know if the earnings are before or after the closing bell, but they're looking at 25% less on their earnings per share, which is actually fairly reasonable. And the revenue is a little higher. I'm not really looking at revenue that much. I'm looking at EPS. That's where the money is. And you'll see there's a lot of other companies. Avalon Bay, one of the biggest real estate investment trusts. They do a lot of mixed-use buildings in California, is reporting today. And here on the right side, you see all the expectations. CME Group is reporting. I'm very anxious to see what number they actually come up with. More importantly, forward-looking statements. One thing I want to bring to your attention from what I'm seeing so far, and so far we're about halfway or more than about 60% done. The EPS is not what's causing the stocks to move. It's the forward-looking statements. It's what the company expects and how much cash they're saving. And typically when you see earnings like that, when you see this type of a reaction to earnings, that's a very bearish market sentiment. That's not a bull market sentiment. Bull market sentiment works on the expected EPS. Bear market sentiment works on forward-looking statements and cash flow. So, like for example, there has been no consistency amongst earnings on the FANG stocks. One did well, came out negative next day. One did better, looked worse the next day. Forward-looking statements is what's driving price right now. So you've got Equifax, you've got Fox A, you've got Goodyear Tires, you've got IFF, you've got Mattel, you've got MGM. It'll be interesting to see how China plays into that. You've got O'Reilly Auto Parts. That company's been just crazy this year. You've got, let's see here. You've got THC. You've got Uber. You've got XPO. That's an interesting stock. Yum Brands. And tomorrow you've got PayPal. It'll be very interesting for technology tomorrow. Big, big, big day for tech. Now, in terms of global economy, I already mentioned the market's down a little bit, but let's see what's going on and see if we can make any heads or tails about what's causing this. So, three major benchmarks yesterday fueled higher. Communication was higher, energy was higher, and technology was higher. Consumer discretionary it closed higher, but the lows are getting lower, which is actually what I'm looking at, and it looks like we're filling in that gap. Let me actually show you exactly what I'm talking about. You'll see right here. See, we're at the 200-day line now. We've been going down, and the question is, are we going to bounce higher or are we going to go lower? And notice the lows are getting lower, and we filled this gap in completely. And if you look at technology, it's exactly the same thing. So to me, see how it's just sitting around there? And let's look at the QQQ as a whole. See, it's not moving higher. That high has peaked. So as long as we move lower from this point on, the market's going to come down, not higher. This is what I'm talking about. Let me just show you. The peaks, the highs have been getting lower. You see that? And the lows have been getting, the highs have been getting lower and the lows have been getting lower. That's kind of what I'm trying to say. You could see it really well here on XLY. But this is the 200-day line, and we're literally, we banked off of it yesterday, and it looks like we're coming back down. But we went from 158 all the way to 147, and it looks like we're opening about 85 ticks lower on the day. So don't try to tell me that tech stocks are going up right now. They are not. They may look like they're going up, but they are not. They're actually consolidating and congesting. So Federal Reserve Mr. Jerome, Powell said yesterday that the red hot job report released last week underscored the central bank, and it has more work to do to bring inflation down to the 2% target. When you have 500,000 people getting jobs, that's a market that could withstand higher interest rates. Federal Reserve Powell acknowledged disinflation again and said he expects 2023 to be a year of significant decline in inflation. But as he likes to speak from both sides of his mouth, he said, caution that if more job reports on inflation data come in well above expectations, the Fed may raise rates more than the market expects. Well, here's my response to Mr. Powell. See, that's a loaded answer, and I'll tell you why. Do you know how many jobs have been lost in the last couple of months? Do you know how many layoffs tech companies have been doing? Do you think those people are just sitting there, or they're looking for new jobs? They're obviously looking for new jobs, and that's going to be reflected in the new hires report every week for the next several months. So we already know that number is going to be inflated. So if that number is going to be inflated, he's got more work to do. But here's the big part, and here's what you need to pay attention to. Neil Kashkari, this guy doesn't lie very much. Look at what he said. Tuesday, that strong U.S. jobs report showed that the Fed has more work to do in tightening policy, keeping his rate outlook at around 5.4%. Now, Mr. Jerome, I'm not going to be honest with you till I'm forced to. He's pricing in right now about 5%, not 5.4%. They've got more work to do. And don't let it fool you. The market is not ready to go higher in the long term. It's just not, unfortunately. I wish I could tell you it is. So 5.4 is what I'm looking at as well. Microsoft climbed 4%. They've got really good news, and I've been meaning to talk about this topic. If you guys come to my VIP room today at noon, my regular time, I'm going to talk about the OpenAI chat box, ChatGPT. I'm going to talk about it extensively. I've been getting a lot of questions on it, but I think this is brilliant. I may actually start using their browser because this ChatGPT is amazing. And the things you could do with it are amazing. It's not a fad. It's the future. Fourth quarter earnings results continue to roll on. We've got Disney, CVS, Uber. Very much looking forward to seeing what all of these three have to say. Now, here's the bad part. And for anybody who thinks this market's going higher, let me sell you some ice in Alaska. Now we're looking at 3.1% negative. We went from 1.6 to 2.6 to 2.9. We're now at 3.1. I don't care what the Fed tells you. If earnings estimates are going down, it's not going to help the stock market. All eyes are focused on crude oil inventories. We may get a little shift in energy prices. We've been getting some higher prices in crude oil. It'll be interesting to see if they remain that way. We're also going to get some numbers on U.S. wholesale trade inventories and gasoline inventories. That's all happening today. In Europe, stocks are up because of the positive hangover from the upbeat session that we had yesterday. Chemical stocks are up, and I think chemical stocks are some of the sectors that I'm really focused on right now. I'm getting really nervous on technology, but I like the basic materials, industrial, chemical stocks. Those I think are going to do well. China closed lower as investors brace for new inflation data for January. We'll know the impact of them lifting their COVID-19 curbs. So that'll be a very interesting report. I cannot wait to see that. On Wednesday, data showed that the countries, this is Japan I'm talking about. I've moved from the second biggest economy in the world to the third biggest economy. They're talking about account surplus contracted significantly and soft earnings report. And we're having soft earnings report in America, and China is just one step away from getting back into the COVID period. You've got some stocks that are moving this morning. Fortinet up 11%, Enphase up 10%, CMG down 5%. That's the big burrito right there. And Sherwin-Williams down more than 3% after a downgrade, which makes sense because less people buying homes, less people doing real estate, less paint sales. That actually makes perfect sense. Again, look at all the companies that are coming out with earnings. The big ones, as I mentioned to you, are New York Times, O'Reilly, MGM, Disney, the big mouse, Avalon Bay, but they're all right here. And if you don't have this report, feel free to email me. I'll send it to you. I update it every week during the big news. And tomorrow, you've got PayPal. Now, As I mentioned, the market's a little lower today. Momentum levels, folks, they're starting to get more red. Notice we're getting more red and purple here. You've got a lot of overbought sectors. Vulnerability is in fact setting in. The Dow Jones only has 57% of stocks trading above the 50-day moving average. That is not happiness. Looking at the bond market, let's take a look at the bond market. It's cooling off, and if it cools off anymore, and I want to show you something. If we break below this level right here, which I think we will, it's going to increase interest rates. Remember, when bonds go down, interest rates go up. When bonds go up, interest rates go down. We look like we're consolidating in this little area right here, and it looks like we're going to break down. As soon as we start breaking lower, that's going to put pressure again on technology and semiconductor stocks. Look at how they've been doing, right? Bonds have not. They've been neutral. Matter of fact, they've been beyond neutral. They've been moving higher. But I think they're going to break down and come back down, and that's going to put that pressure on the consumer discretionary stocks that I've been talking about and cause this to go back into our range and cause the Dow Jones not to go higher, but actually to go lower. If you look at the Dow Jones over the last several months, look at where we're doing. It's not moving higher. It makes you think we're moving higher, but the Dow Jones has been just moving sideways. It hasn't been moving up at all. So be very, very cautious right now with the current momentum levels. Be very skeptical and be very, very selective. Now, today's Wednesday, and usually on Wednesday I give you the number one stock to buy and the number one stock to sell. Well, guess what? I'm going to give you several stocks to buy today. What do you think about that? So the first stock that I really, really like is Dow Chemicals. Remember I told you chemical stocks? This is a basic material stock. I like this stock. I think it's going to go higher. Look at the last 3 months. Nice. Brinker International. This is a restaurant, eating place, Chili's, Maggiano's. I love Maggiano's. They're looking really well right now. It's looking great. Look at that. Another one, Shift for Payments. Look at this stock. Look at this trend. Nice, huh? I like this. Shift for Payments. And I think, let's see here. Yeah, integrated processing. Again, we're just going with the momentum right now. And to the short side, you've got VFC right here. I think this is going to come down all the way to the $25 level. And you've got Southwest Airlines. I think energy prices are going to bite us in the ass, and I think interest rates going higher is going to put pressure on airline stocks. And I'm expecting this baby to go down to the 32 level. So alongside, we've got Dow, DOW, you've got EAT, and you've got FOUR. To the downside, you've got VFC, and LUV. Now, something important that you need to pay attention to. I've uncovered, and I'm not kidding, a very, very cool pricing mismatch in the stock market that will shock you, and I mean shock you. It has to do with ignoring a stock's share price and focusing on the options price instead. Now, with this pricing mismatch, a tiny little tiny 1% move in the stock could lead to gains as high as 31, 41, 46% in a matter of days. The value of these opportunities presents itself, from what I've seen, is better than anything else I found in the market, especially in this crazy Michiganer market right now that we're in. Michiganer means crazy in Yiddish. It's a word my grandmother used to use. And once you learn how to use this pricing mismatch to your advantage, you'll never look at stocks the same way ever again. I'm not kidding. You guys are going to love this. So if you're up for a good old bargain hunt, click the link below. And if you're watching in the YouTube channel, follow the link in the YouTube Wealth Press channel. It's below the video. It's right there. Follow along. The markets are still very, very shaky. We're not out of danger zone. You've got consumer discretionary stocks sitting right at the 200-day moving average, and even technology, even tech, has not been able to take out the previous high from the last 1, 2, 3, 4 days. So be very, very cautious, and I think we're going to be hitting the 200-day moving average. Post your comments in the YouTube channel, and I will respond there, and everybody will benefit from it. Bye, guys. Have a great, great hump day. be careful. The big mouse is out reporting today. Bye.